Hello everyone and welcome back. I'm Tanuja Yadav and today I bring to you the 6th video in the series of Let's Invest. In this video, I'm going to talk about how a person can determine his asset mix. Now let's first discuss the asset mix on the basis of the risk profile. In the previous video, you must have learnt about what your risk profile is. So you would know whether you are a conservative investor or an aggressive investor or a balanced investor. Now let's see how an aggressive investor should invest in a portfolio. Now this is very similar to a person who is very young in his early in his career. He has just started his career. He's in early 20s or 30s probably. So most of his investments should be in shares. So you can see that a huge chunk of the portfolio, about 65%, has been suggested to be in shares. The remaining 35% of the portfolio should be split in cash, bonds and property. Yes, that is still a right time for you to invest in property, so you should start early. Let's now talk about the medium risk investors, people who are either balanced investors or they have a modest risk tolerance. For them, no more than 35% is suggested in shares. They should move the money from shares towards property. So 35% should be invested in property, 15% should be available in cash, and 15% should be invested in bonds. Talking about a low risk investor or a conservative investor, the one who was on top of the graph that I had shown you, for that person, 45% should be invested in property, 20% should be invested in bonds which are considered relatively safe, 25% should be in cash, and very less component, 10% only, should be invested in shares. Now, amongst these categories, when I say high risk, medium risk and low risk, there can also be a range. So medium risk does not mean that you have to follow this pie chart verbatim, but depends upon where in the range on medium risk are you. Are you more towards conservative or are you more towards aggressive? If you're more towards aggressive, then you can increase the component of stock holdings and reduce the component of property holding. Same way, in the low risk also, there are ranges. So if you are very, very conservative, you have absolutely no appetite for risk, then stocks is not what I would suggest for you, not even 10%. Then you should focus on bonds, property and keep some cash available with you. Now again, for aggressive investors, those who are really aggressive, who just want outright growth, they want aggressive growth in their capital, then they can move all out of their property and move it in stocks. They can even go 90% in stocks if they like, if they are more comfortable with that. So it is something that you have to get used to over a period of time. You have to understand your own position better and then make these decisions. Let's now talk about asset mix on the basis of time horizon. Now, depending upon whether you have a short time horizon, a long time horizon, or a medium time horizon, there are different types of asset mixes that are suggested. For people who have short time horizons, that is between 1 to 3 years, very less stocks, only 20% stocks and 80% bonds are suggested. Now again, as I told you in the previous slide, here also there is a range. There is a range of 1 to 3 years. People who have a time horizon towards 3 years, they should invest in stocks. But if you have a time horizon of less than 1 year, believe me, shy away from stocks. If it is towards 1 year, then don't invest in stocks. Keep your investings in the bond only. If you have a mid time horizon, say either 2 to 4 years or 3 to 5 years, then you have to balance out your portfolio accordingly. Say for a person who has a 4 years of time horizon, he can keep 50% bonds and 50% stocks in his portfolio. However, for a person who has a 5 years time horizon, 5 year is significant in terms of stocks also, because if the stock loses value, it still has sufficient time to bounce back. then you can move towards a growth kind of a portfolio, having 70% of your investments in stock and 30% in bonds. Now, if you have a longer time horizon, say 7 years or beyond, 10 years, 15 years, 20 years, then you can adopt an aggressive portfolio. Now, I'm only talking about the money that you are investing in the financial markets. I'm not talking about your complete holdings. So you still have a certain amount invested in property and certain amount held in cash in your saving bank account. However, the money that is going in the market, this is just the split of that. So if you have a long time horizon, say if you are investing for 7 years, 10 years, 15 years, then you should take an aggressive approach and you should invest more in stock. It could be 85% or it could be even more depending upon your comfort level, your comfort in stocks, your knowledge of stocks, and less towards bonds. Now again, let me elaborate a little on age appropriate asset mix. If you have more than 20 years left to your retirement, that means you have started in your career or you are just about to reach the mid-age career, then you can, out of the holdings in stocks, you should have 30% on large cap stocks, 35% on small cap stocks. Now, small cap stocks are the stocks of the companies which have small capitalization, which are smaller companies, so there is more risk in them. But as they get established, of course, there will be a bigger return also in them. Then they can invest some amount in foreign stocks as well. Foreign stocks can be risky because not a lot of people have complete knowledge about foreign stocks, but you can study, and foreign markets are good markets to invest in, but only after you have studied about them. They can also invest in balanced funds and long-term bonds, but very little. I would not suggest more than 20% to go in long-term bonds and balanced funds. Again, this really depends upon your risk appetite. If you are early in your career but you have absolutely no risk-taking appetite, then of course move from large and small cap stocks or probably just ignore foreign stocks and keep more of your money in long-term and balanced funds. But if you are confident, if you want to take risk, then I would suggest that you move towards an aggressive growth portfolio, investing most of your money in small cap stocks and large cap stocks. Now, in your middle career, suppose if you have 10 to 20 years left to your retirement, then you should start diversifying out of stocks. So here you have diversified out of small cap stocks, keeping more of your money in large cap stocks, which are large capitalized companies, which are big companies, they are established, and there is less less variation, less variability or less volatility in their stock prices. You can expect less risk in those companies, but of course there will be less growth in the stock value also. So here you're moving your money out of small cap stocks and you're moving more towards large cap companies. You may or may not keep foreign stock if you like, and you are putting more money towards balanced funds and long-term bonds. So from the small cap stocks, I have taken out money and put it in large cap stocks, balanced funds and long-term bonds. You can increase or decrease these percentages depending upon your confidence level. Now lastly, if you are nearing your retirement, if you have just 8-9 years left to your retirement, that is the time when most of your money should be in balanced funds and long-term bonds. You should have less money in stocks because again, stocks are volatile, they are risky. You do not have a lot of time to recover from any bad phases if there might be. And you should also at this stage invest in money market mutual funds. I'm not talking about retirees here because I think I already clarified that in one of the previous presentations, that retirees should focus on keeping most of their money in income bonds, that is in fixed income bonds, because they are more concerned about capital preservation and income which will support their retirement. Well, that is it, and I hope with this presentation you will be able to start forming your portfolio. You will be able to know what is your risk appetite. You will be able to know what kind of assets you should be investing in. So do a little homework as you move on to the next presentations. Thank you very much.